Matthew Sutherland, Senior Investment Director for Asian Equities at Fidelity Worldwide Investment. He joins us live from Hong Kong. So good morning to you and thank you for joining us. The world is divided on how one should read the US economic recovery. The bulls are of the view that it's all about weather, but somewhere bears are insisting that none of the data points are encouraging.
So, I mean, we're very positive about the U.S. recovery. I think if you look at it, smoothed over a long period of time, you can see that, the animal spirits are coming back in the U.S. And there's a number of very positive things happening. For example, the shale gas dividend, which will enable the U.S. to become energy independent in the relatively near term, and some fiscal discipline returning to the mix as well. So, in general, I think we like what we see in the U.S.
Matthew, you're positive on India. What's the take currently on the fiscal health of the economy? We've had all the data come in. Inflation was higher yesterday. We've got the CPI, WPI data points as well. How does it stack up with your overweight rating on India?
I'm sorry, your question was on India rather than the US, right?
Right, that's right.
Yeah. So with regard to India, I think, again, we're positive on most of the cyclical indicators. I think, one can get too tied up on single data points. And, if you look over time, a single data point might be up or might be down. But basically, we like what we see again in India as well. I think, both what's happened on the current account is very positive. And it looks now that we might be entering, an earnings upgrade cycle, having been in an earnings downgrade cycle for some time. So perhaps ignoring some of the short-term individual data points, in general, we're positive about what we're seeing in India too.
But some would argue that there's nothing special or unique about India. Surely Indian markets are at an all-time high, but the performance or the outperformance in India is in line with other emerging markets. Markets like Argentina, Turkey, Pakistan, Brazil, everything is up in a synchronized manner.
Yeah, and I mean, that brings us back to the global environment, which I think is still extremely positive for equity markets generally, whether it's the US, whether it's emerging markets. The fact of the matter is that central banks globally, however much we like to talk about tapering, central banks globally are still injecting liquidity into markets, and that's very positive for asset classes generally. So, we would expect to see equities continue to be well supported going forward. And I think we've now had, a 5, almost 6-year equity bull market, and we expect that to continue.
So what is your view on Indian equities? Would you have a fiscal year end target for the Nifty, given the current macro picture, the big event in, elections as well upon us?
We don't have, individual index targets at Fidelity. We let our individual portfolio managers get on with kind of picking stocks, and we're a very bottom-up house, so we do a lot of bottom-up research to try and identify the best companies to invest in. So we don't tie ourselves to index targets. What I would say is that our managers are finding lots of opportunities still in the Indian market. It's a very broad and deep market, and we're finding opportunities to invest in companies where we think the fundamentals are good and the valuations are okay. And that's in a broad range of sectors, actually. It's in the export area, but it's also in the domestic demand area, and even now in, looking for opportunities in some of the domestic cyclicals. So lots of opportunities in the Indian market, I think, at this point.
What is your take on absolute valuations for Indian equities? Because what is growing in India, which is IT or some banks or private banks, they are not cheap. What is not growing in India is cheap. So which way are you leaning? Are you hunting or are you treasure hunting in the quality pack or in the value pack?
Yeah, that's a very good question. And we have exactly the same question, by the way, in China, not to go too off track, but exactly the same issue in China. And in fact, we've seen the same issue, I think, globally. So we've, over the last 2-3 weeks, seen a very big rotation out of growth stocks into value stocks, so out of the kind of loved but expensive parts of the market into the less loved but potentially showing more value parts of the market. And our view is that you can find opportunities in both. So I think one needs to avoid being overly kind of generalizing too much about this and saying we should sell all the growth stocks and buy only value stocks. Again, coming back to my point, that there's no substitute for bottom-up equity research in our view, and that's what we concentrate on doing at Fidelity, and we're finding opportunities in both camps. So we wouldn't advocate a wholesale departure from the expensive growth area into the cheap value area. We'd be looking at both and finding opportunities in both places.
Matthew, how important is China, or rather how critical is China at this point in time? We've seen the GDP beating the growth forecast, but nonetheless the growth has slowed in terms of the GDP data. How important is China going to be in terms of the global equity movement?
I think China is incredibly important. It's obviously one of the things that's driving sentiment globally. So people are watching very closely the credit situation in China, and they're watching very closely also the GDP growth number in China, because I think everybody is aware that the government has a fine line to walk in China, balancing on the one hand their stated GDP growth target with the need to rein in credit expansion, and the two things often seem mutually incompatible. So if you rein in credit expansion too much, then you lose on the GDP side, and if you try and hit the GDP target, it's hard to do it without expanding credit. So I think the government's walking a fine line, and we'll expect to see some kind of fine-tuning in the economy, like, for example, the mini stimulus package, which was announced just a couple of weeks ago, to look to kind of try and hit the growth target without too much credit expansion.
Final question. One striking data is the liquidity picture, the flow picture. Now, most of the emerging markets this year have got net outflows, but the news from India is that foreigners have pumped in about $4 billion of fresh inflows. Are you a bit surprised? Why is so much of money coming to India, and 50% of the money which is coming to emerging market is now officially coming to India?
Yeah, I think it's a really good question. So firstly, I mentioned the rotation from growth to value that we've been seeing over the last couple of weeks. The other big rotation that we've seen last month for the first time was big rotation out of developed into emerging markets. And in the month of March, all the Asian emerging markets saw inflows across the board, and it was the first time we'd seen that happen for a very, very long time. And India is interesting because, as you rightly point out, it's had foreign inflows in almost every month going back the last 18 months. I think there were only a couple of months in the summer last year when there were a couple of outflows. Is that surprising? Yes, I think it is a little surprising. I think it comes back to the fact that, as I mentioned earlier, our analysts and portfolio managers, irrespective of what's happening in the macro environment in India, always seem to be able to find good investment opportunities among a broad range of companies in India. There are some very well-run businesses in India that trade on acceptable valuations, in our view. So kind of irrespective of what's happening in the macro backdrop, I think foreign investors always see India as a place where they can find good places to park money.